Welcome back, everyone. Today we're going to talk about the news that broke yesterday from Applied Materials, another chip adjacent company, and Nick is going to go on a mini rant about silicon carbide and gallium nitride. So you have to stay tuned for that till the very end. But to kick us off, we'll start with the news that Applied Materials, one of our favorite companies here at Chip Stock Investor, talked about yesterday in a press release. Nick, what did they share with us yesterday?
Before continuing, let me remind you to hit the like button and subscribe to the channel if this video is helpful as you do your own investment research and increase your knowledge of business and technology. We really appreciate the support, as subscribing to the channel helps us continue putting out content like this.
Yeah, Applied Materials, ticker symbol AMAT. We reviewed their quarterly earnings last week, but they were a bit of a tease, weren't they? Last week they said they were going to have a big announcement for us on Monday that they didn't want to reveal at the time of earnings. So maybe just kind of boosting their media attention here a bit. But at any rate, it was interesting news. Maybe nothing that has an immediate financial impact. At any rate, Applied Materials announced the EPIC Center, all in caps, EPIC, EPIC Center. They're going to be building this thing. It's a giant research and development facility that will be in Silicon Valley. And it's a place for Applied Materials to test out and develop chip manufacturing equipment. But it's also going to be an open R&D facility for their partners as well. And these could be actual chip designers. NVIDIA and AMD both had some comments to go with this press release. So fabless chip designers as well as actual chip fabs. So TSMC was also in this press release as well. So channel partners from design to manufacturing, basically getting invited to play in Applied Materials' new sandbox. This thing will not be finished until 2026, it sounds like. So this is a 3-year project. It's going to cost $2 billion over the next 3 years to build. They're going to be applying for some CHIPS Act funding. Remember, $53 billion from the U.S. CHIPS Act. Only $39 billion of that for manufacturing. The other 14 billion is for R&D. So Applied looking for some of that money to build this. But really interesting. I think the point here is it will help accelerate future development of chips, which is getting mind-bogglingly complex. These companies working at the nanometer scale, the finest features of chips, just a few atoms in dimension. So this could be a way for Applied Materials to continue pushing development of new chips forward and kind of keep their business model strong and stable over the long term. What did you make of this announcement, Kasey?
Yeah, basically it sounded like a McDonald's play center for the semiconductor industry is kind of the way it sounded like to me. I mean, it's just going to be this huge facility where Applied Materials gets to show off their materials, their manufacturing equipment for all of these companies. So to accelerate the research and development of more advanced chips. Do you think this will help them to use Applied Materials equipment more than they already do? And do you think this has a financial impact on the semiconductor industry?
I don't know that it will necessarily increase adoption of Applied Materials equipment. This company already has the broadest portfolio of equipment. I think this is by no means a household name. I think investors that are aware of the chip manufacturing equipment niche of the industry automatically think ASML Holding. And oftentimes I think Applied Materials just is maybe this lesser known name, but it's actually the broadest portfolio of advanced tools, already an absolutely critical component of the manufacturing industry. In fact, ASML could not do what they do with EUV lithography without Applied Materials help, because AMAT provides things like the reticles needed in EUV lithography. So this announcement, in my mind, is almost a bit of a flex from Applied Materials. Like, hey, remember us? We're actually, this key linchpin in the entire chip ecosystem. So I don't know that it necessarily increases the adoption of their equipment. However, this company has deep understanding of the chemistry of chips. They help companies with novel materials when they're making chips. They help with advanced design. So as we approach 2 nanometers, and then beyond that, the angstrom level of chip design, basically itty bitty, tiny, microscopic features on chips, they're going to help with that. And then, of course, software needing to converge with the chip design as well. They also do that. They have a software service business that's roughly 20% of their revenue. So I think it helps just keep their momentum over the long term going. And it's a reminder, probably not to the industry. The industry understands how important Applied Materials is, but maybe to investors, like, hey, don't forget about us. You really need us.
Yeah, exciting stuff. I think we'll just kind of wait and see what happens from here. Okay, let's move on to our next topic, which is a semiconductor adjacent field, sort of. It's a couple of companies that use the technology very much in their business model, and that's Booking Holding and Airbnb. So why are we considering these chip adjacent companies, Nick?
It's what the people want. They wanted more chip adjacent industry coverage. So a couple weeks ago, we did what we like to call an upstream. So suppliers to the chip industry, if we can borrow a term from the energy industry, we'll call that upstream suppliers. Now we're going to do downstream, companies that benefit from chips once they're manufactured and deployed in the field. And Kasey, I think you're absolutely right. The online travel booking industry, Booking Holdings has been doing it for a couple decades now, previously Priceline, now Airbnb. Absolutely 100% their businesses are, they can thank the semiconductor industry for their businesses even being possible. Of course, the internet built with chips, basically. And then even Airbnb, I think this advent of mobile technology, mobile connectivity over the last decade and a half really made Airbnb's business model. Because if people weren't able to work remotely and access work from anywhere in the world, I don't think Airbnb's business gets anywhere remotely as big as it has today. So that's why we're covering this. But I know you have some special qualifications to talk about the travel industry. What are your qualifications for discussing this, Kasey?
I believe I'm a genius level 1 on Booking, which is the lowest level genius, of course, but still there. I have that qualification. And then for Airbnb, we have stated a number of Airbnbs, especially in the last year, on 4 continents. So I feel like we're pretty well qualified to talk about this subject.
Okay, let's go through our typical outline here, where we start kind of high level and then work our way down towards valuation and price target. Kasey, give us a high level overview of each of these businesses for the folks that aren't aware of what they do.
Most are familiar with both of these companies. On Airbnb, a host can host their home or experience on their platform. Booking is a little bit more broad. Of course, they have all kinds of vacation travel plan options, flights, rental cars, and of course, hotels and homes also hosted on the site. And obviously, Booking is a very large conglomerate. Booking.com, Priceline, Agoda, rentalcars.com, Kayak, all of these companies fall under that Booking Holdings title.
Okay, so I'm just going to very quickly run through financials here from Q1 2023 at a very high level because if you know these two businesses, you probably have already seen the numbers. But basically, Booking Holdings, the big conglomerate, does roughly double the revenue, a little more than double the revenue that Airbnb does, which makes sense. Booking, which started as Priceline, has been around for 25, 26 years now at this point. Interestingly enough, though, despite the far bigger size, their revenue grew about 40% year over year, versus Airbnb, their Q1 revenue grew 20% year over year. Even more interesting, Airbnb, again, half the size as measured by revenue, expecting to grow 12 to 16% in Q2 2023. Booking Holdings, they give a little less specific numbers here. They basically predict that their room nights growth will be mid-single digit year over year growth. However, there's some things going on with the business here where they're making this migration from an agent model to a merchant model. So their room nights mid-single digit, but revenue will grow a few basis points more than that. Plus, we have the airline and rental cars business as well. So in spite of the bigger size, it looks like Booking will grow at roughly the same rate as Airbnb in Q2, if not slightly more. There's a possibility they could actually grow again more quickly than Airbnb.
Looking at free cash flow, I can see that Airbnb has slightly more over the past year, 44% versus 42% for Booking Holdings. What do you think about these companies' free cash flow generation, Nick?
It's impressive that Booking is still, after all these years, generating such high free cash flow profit margins. 42%. Bear in mind, this business is not perfect. They have acquired many of these other sites that you rattled off, Kasey, like Kayak. Their foray into the restaurant reservation management industry did not go so well. Remember OpenTable, not a piece of software you hear about very often, but Booking owns that. They way overpaid back in 2014 and wrote off about $1 billion worth in value from that acquisition. But 2 years later, in 2016, despite some missteps, as well as now the pandemic, the last few years, highly profitable business model. And I think they actually have room to increase that margin a bit too. So historically, Booking is an agent. Basically, an agent is basically they just facilitate the booking. The traveler pays the accommodation directly. So like, let's say you book a hotel room on booking.com. Under the agent model, you pay the hotel directly. And then later on, after you've traveled, then that hotel pays the agreed commission to Booking Holding. They've been making this transition over to the merchant model, which Airbnb is 100% the merchant model. And this typically, I think, it's held that this is a more profitable business model for Airbnb, thus, the slightly higher free cash flow margin. Traditionally, more profitable business model, maybe less favorable to the host. But basically how this works is when you travel, you are paying the merchant. In this case, Booking, making this transition to the merchant model, you would pay Booking. And then once you've traveled, then Booking pays the proceeds to the accommodation. let's say the hotel room or the unique place to stay, someone's home or apartment or room or whatever, minus the agreed commission and fees. So that's how Airbnb works. When you book something on Airbnb's platform, you are paying Airbnb, and later on, Airbnb forwards the agreed upon proceeds to the host. That is a very lucrative model because Airbnb basically controls the money. It controls has greater control, I should say, of the relationship with us, the travelers, and then the host kind of just relies on Airbnb to do a lot of the legwork, including handling payments and whatnot. So there's some benefits there for the consumer, the traveler, definitely benefit to Airbnb. And again, booking, they finally surpassed 50% of their business coming from merchant payments versus the older agent model. So there's benefit for them there too. And yeah, fantastic free cash flow margin. And I think there's actually room for that free cash flow margin over time to continue to increase for booking.
Let's talk about some of the issues that have come up, especially since the pandemic really has ended and more people are traveling. Airbnb has come under a little bit of scrutiny and some heat over the inconsistencies in their homes that are hosted on the platform. And we know this firsthand, right? We've stayed at, as we mentioned, many Airbnbs, and we have had wildly varying experiences between hosts, between homes. We have used some experiences as well, and that has also been very inconsistent. Sometimes you'll get a great experience, you'll get a great home, and then other times you get there and it's terrible, and to be quite frank. And the other issue is the inconsistent fees. One host can charge a minimal amount for cleaning, and the next can charge an absolutely outrageous amount for cleaning. And so these things have definitely caused, I know, us to look more at booking.com. And so if that's the case, I know that other people are doing this exact same thing. So what do you think about this? Like, how will they fix this issue?
Yeah, those are very valid points. In addition to that, Kasey, this is another thing a lot of people complain about, including you. You mentioned on Booking, you're Genius Level 1. They have a rewards program. Airbnb has yet to introduce something like that. And with their merchant model, 100% merchant model, they absolutely can launch some sort of reward program because they are the merchant. They control the overall relationship with the consumer. That's another issue that they can fix. I guess the thing to bear in mind here, though, this is a very young business. Airbnb didn't even launch until 08, 09, barely, not even a decade and a half ago. Booking has been at this now for, again, since, the dot-com era, mid-90s, with a very young business, and especially one that has undergone such astronomical growth because of effects of the pandemic and just kind of the very fluid, very changing world we live in. You could expect to see some issues, and it's a risk. But as they fix those problems, if they can fix those problems and issues, they have a ton of upside potential. So very valid points you bring out. It's an inconsistent experience. Booking can be as well, but a bit more of a mature business model overall.
One way we definitely could see growth for Airbnb is rental cars, right? I mean, that something like another company, Turo, could be integrated into Airbnb. Like that model could add value to the Airbnb platform and add yet another way for there to be revenue. But ultimately, I think fixing inconsistencies with how they manage their home, those who host their homes and on their platform will make a huge difference.
Yeah, and another great point. I know some investors worry about Airbnb branching out into adjacent parts of the travel industry, but Booking Holdings is a fantastic model here. Remember, this is a very, very asset light business. It costs very little for a company like this to launch a new service, and it doesn't take a ton of people using it for it to suddenly become very profitable. Airbnb has actually already done this. They host experiences. Not only can you put your home or a room for rent on their platform, but if you have like some special hobby, a unique hobby, or have knowledge of the community you live in, you can host a tour or something like that on their platform, and it's kind of like a lob pass for Airbnb. Very easy to just add that to the site or the app, start making money on it, and that shows up in the free cash flow profit margin. 44% for a business this young, absolutely incredible. And you're showing the charts here, Kasey, from our friends at Main Street Data, share buybacks. They're using, both companies using their high rates of free cash flow and plowing that into share buybacks. Booking has been doing that for a very long time, sans pandemic, of course. And then Airbnb, of course, just started doing that here the last couple of quarters. These are asset light business models that spin off massive amounts of cash, and they are very shareholder friendly with that cash generation.
Let's go ahead and talk now about valuation for these two companies and maybe price target, and ultimately, which one would you invest in right now?
So we're talking about this because we actually used to own Booking Holdings. We owned it for years and then ended up selling it in 2019 because it was kind of just stuck moving sideways, I guess. The business was growing, but the valuation was high, and it was sort of making the transition from growth stock to value stock. We sold in 2019, then the pandemic started, so that was cool. Nothing we predicted timing wise that we can say, hey, look at how awesome we were on this. That was just dumb luck. But we re-entered the travel industry. We made an investment in Airbnb late in 2022. Our patience, I guess, did pay off. Airbnb was interesting at IPO, but wildly overpriced. But roughly 2 years later, the valuation looked attractive. So we started our position in Airbnb in November, back in the travel industry. But we still think both companies actually have a lot of growth ahead of them in the next decade, including Booking, even though I think they have fully made this transition from growth stock to now value stock at this point. There is especially a ton of growth potential for them in international markets outside of the US, especially in emerging markets, in particular in East Asia, where the middle class is growing very quickly. People have a growing amount of disposable income. And of course, when they get disposable income, they start traveling. That will, in particular, we think, fuel Booking's more gradual rate of growth over the long term, even though we think there's a possibility they could actually be the faster growing business in the short term over and above Airbnb. Today, if we were going to make a online travel stock investment, Booking kind of looks like the more attractive buy right now at this moment. Very, very simple valuation metric here, but Booking at just 14 times trailing 12-month free cash flow to almost 20 for Airbnb, which is really interesting, Kasey, because everyone wants to talk about Airbnb, and it's like Booking has been completely forgotten, right?
Yeah, I think that's absolutely true. Airbnb is by far and away more popular when it comes to hearing from investors. But I think you're right. I think Booking has a ton of potential. And I see as people just from a customer perspective, as people get more and more fed up with some of these situations that I talked about earlier, I think more and more people are looking to stays and experiences with booking at this time. I think Airbnb also has a ton of potential, but at this moment, I think booking is looking pretty good from an investing standpoint.
Yeah, so maybe like fair price, target, just kind of using our, penciled out on a napkin valuation metric. We think Airbnb's fair price is roughly 120, which is why we started buying in late 2022 when it was well under $100 per share. So we think it's basically fair price. Let's just call it fair priced at this point. Although if they fix some of these issues and kind of reignite their growth, we see plenty of growth potential from here on. But we think it's a fair value right now. Versus booking at less than 15 times free cash flow, with the potential to maybe not grow as much over time, but certainly they have the ability to increase their free cash flow margin. And of course, as the more mature business, returning much of that free cash flow in the form of stock buybacks, that is a very, very lucrative business model, currently at roughly $2,700 per share. I actually think a fair value on this, as 2023 kind of progresses, I think we could see this thing shoot over $3,000 per share. We're not a stock timing service at all. So if you like booking for the long term, that's the real reason to buy this. But we do see some underappreciation for the business reflected in the price at this point. And if you're looking for a timely ad for the long term, for the long haul, we actually think booking is the better buy right at this moment.
Okay, before we close out this segment, I just wanted to point out, Nick, that it looks like you have your little anchor shirt going on here. So are you ready to go on some vacations?
I did not put the shirt on purpose, but I guess it's appropriate considering we made this detour on the travel industry.
Yeah, it's the beginning of summer. I think we're all thinking about maybe our summer vacations at this point. So that's why we're talking about Airbnb and Booking Holdings. Now, the moment you've all been waiting for. I think we needed like a special segment here called Nick's Rants, but we're going to go into it right now. We're going to allow him to talk about silicon carbide and gallium nitride and why, as investors, you may need to be a little bit leery of these terms in a sense. Nick, what do you have to say about this matter?
Yeah, are the rants like already kind of a feature of this? I feel like some of our listeners have chimed in and said that's why they show up. They're looking for the rants. This is an important one though, because I feel like maybe even more broadly than silicon carbide and to a lesser extent gallium nitride, but maybe just EV, electric vehicle chips in general, really feel like this is starting to sound like the cloud of the semiconductor industry. A lot of these companies that are essentially just startups at this point are using phrases like electric vehicle chip leadership, silicon carbide design leadership to capture investor attention. And they have yet to actually even prove that they are leaders in this niche of the semiconductor industry. And I say that because I think a lot of investors get drawn in by the blistering pace of revenue growth from some of these companies. I'll just rattle two of them off. Indie Semiconductor, which we've done videos on before, and in fact, I have invested in. And another one that has really kind of rocketed higher in recent weeks, Navitas Semiconductor, ticker symbol NVTS. And obviously this is chip stock investors, so I think we we see a lot of comments and we get a lot of feedback on various platforms, and there has been rising interest in these companies, but we worry it's not rising interest because investors are building their confidence in the business. Their confidence is building with the stock price. And we've already learned, we should have already all learned this lesson in 2020, 2021, and 2022. Your conviction should not go up because of the stock price. If you're a long-term investor, if you're a trader, that's a different story. But your conviction in a stock should not go up simply because the stock price is going up, which we think is kind of tied hand in hand with the silicon carbide leadership, EV chip leadership messaging these businesses are kind of throwing out there. Your confidence and conviction should go up because you understand the business, and the business is getting stronger over time. Now, you can make the case that Indie, Navitas, and some others that are out there, yes, perhaps their business is getting stronger. Their revenue is going up, and they're talking about their increasing number of design wins that they have. But I mentioned these two companies in particular because they're less than transparent with what it is exactly they design. So, Kasey, I think it was almost 2 months ago, maybe a month and a half ago, we talked about Indie Semiconductor, right? We predicted we would see it fall to $8 a share, which it did. And then the Q1 report came out. They beat on revenue guidance, and the stock has shot over $9 a share again. So we actually had taken our profit off of the table before, and we actually decided to close out that position. We think the stock price could continue to run higher. It may shoot back over $10 per share. But as the business grows and gets bigger, we would expect to see more information on what it is exactly they're doing. What are their customers using their chips, their chip designs for? And we actually know just as much about the business as we did, at the IPO roughly, over a year ago. That makes us nervous. Navitas is another one. I think they actually provide some specific design information on their website about their power chips, silicon carbide and gallium nitride chips. But a lot of these companies are patching together growth via acquisition, not organic growth, via acquisition. So we just have very serious concerns about the sustainability of this model, and we are bullish on silicon carbide, but that's why we invested in onsemi. We feel like there's an actual moat there. There's a profitable business at the core as they make the transition to silicon carbide. And be leery of these businesses just toting silicon carbide EV chip leadership before actually proving that they are a leader in that space. If you're a long-term investor, be leery of chasing the hot stock of the moment. This is starting to feel like companies in the last few years that threw cloud leadership or cloud native into their name, into their description, simply to get investor attention, and without ever actually proving that they were an actual leader in their particular corner of the cloud computing universe.
I think these are some really interesting points that you made, because I've read a number of earnings calls from these companies, and I was thinking about Wolfspeed. We talked about this, I think, last week or the week before. Wolfspeed says that they're the pure play in silicon carbide for electric vehicles of the future, and they all mention sometimes hundreds of millions of dollars in pipeline funding. So what exactly does that mean? Doesn't that mean that they have lots of customers coming in, lots of money coming in from these sales?
Yeah, you're right. And Wolfspeed in particular, their pipeline is more than hundreds of millions. It's like they talk about having billions of dollars in pipeline. Navitas, I think, hundreds of millions of dollars in pipeline. Indy talks all the time about their pipeline. It's a good question because I think a lot of investors and even some Wall Street analysts are calling these stocks a buy. And oftentimes you'll see them cite pipeline as a reason to be bullish. But you make a good point, Kasey, because you will not find pipeline on the balance sheet. Backlog you will find on a company's balance sheet, because backlog is an actual order that has been placed and there is some sort of financial commitment from a customer. A pipeline is kind of just like a handshake agreement. Hey, we've tested out your chips and we think that we could maybe put them in our future design 5 years from now. No order has been placed. In that pipeline, the company may have a small portion of that, which is backlog, where there's an actual financial commitment, an actual firm order that has yet to be fulfilled. But pipeline itself, I think, should be viewed with a bit of skepticism. In fact, we had a comment about this on one of our Qualcomm videos too. An astute viewer actually pointed out Qualcomm used the term pipeline at their auto investor day last year and cited a $30 billion pipeline over the course of roughly a decade. Absolutely, it can give you a very general indication of the direction a business is moving in, but it is not a firm financial commitment yet. So do not invest in a stock just because it has a massive pipeline that they like to talk about.
The moral of the story here is be careful with stocks like these. And if you really do want to invest in companies like this, Indie Semiconductor, as Nick mentioned, Navitas, it should be at least our philosophy and the way we run our portfolio is it should be a very small position in the portfolio. Is that, Nick, do you feel like that's a good summary of how we feel about these companies?
Yeah, absolutely. Use the Silicon Valley model. When you hear about, like these private equity firms or an angel investor dropping some money on a startup, always remember, like, they are not betting the farm on that one startup. They maybe have like 100 startups that they've put money into, and their hope is a very small number of them, like single digit out of like 100 of them, maybe 5 of them or fewer actually make money for them. But that philosophy works only if you spread your bets across many small or micro cap names and fully expect that most of them may do absolutely nothing. Maybe they even lose you money. Maybe they go to zero, but a few of them maybe eventually take off and do something. So don't bet the farm on small cap stocks, especially ones that have yet to prove the merits of their business model. Absolutely. That is, I think, the moral of the story, at least as far as our philosophy goes and how we invest in this.
Excellent. So that wraps up this episode of Chip Stock Investor. We've covered a lot of ground today with the news with Applied Materials, Booking and Airbnb, our semiconductor adjacent stocks this week, and our discussion of a couple of companies that have said they've bet heavy in the EV market, silicon carbide and gallium nitride. So please stay tuned. Make sure you hit the subscribe button. We have Palo Alto Networks and Fortinet coming up later this week. Today, Palo Alto Networks will report, and then we'll do our analysis of those two companies. Check out our Main Street data information. If you find these charts helpful, there's a 10% off on a premium subscription. Link is in the description. See you again soon.